Our view is that the renminbi is substantially below a level that's consistent with medium-term fundamentals. This is a long-standing view of the fund. We do feel that a stronger renminbi is needed in China. It will help. It will be in the interest of the Chinese people. It will increase consumption. Will help increase the household income, and ultimately facilitate this transformation of the Chinese economy that the Chinese people themselves, I think, and the government want to achieve, with an economy much more based on private consumption and much less reliant on exports and investment as the drivers of growth.
Yeah, Nigel, the big interesting point from this discussion, I guess, amongst IMF board members is that some directors are actually thinking that you can't, I guess, gauge the current account to the GDP ratio. There's some uncertain forecasts, so maybe the yuan isn't substantially undervalued.
Yeah, as our press information notice pointed out when we summarized the views of the board, there were directors of the board who did not agree with the assessment that the currency was undervalued, and there was a difference of views. I think the staff view, which was outlaid in the staff report, is not reliant on the prospects for the current account, but we look at a broad range of factors, including the level of foreign currency intervention, including things like the productivity differentials in China relative to its trading partners, things like the terms of trade, the demographics, and the current account, of course, is an important feature. So we make a balanced assessment based upon all of those factors.
Okay, let's talk about interest rates, because we had the PBOC, the People's Bank of China, which is the central bank in China, saying that there really is less need right now to lift rates because right now there is no inflation in the country. But what is the IMF's view? I think you said that real interest rates are close to zero and are creating perverse incentives in China. What does that mean?
Yes, I think what we saw last year was a big expansion of credit growth in China, which was perfectly appropriate in the response to the global economic crisis. China pumped out a lot of credit into the economy in order to kickstart the economy and get the recovery going. That worked very well in China, and now is the time to withdraw that amount of credit. It's not an issue related to inflation, but it's an issue related to what the ultimate quality of that credit will be over time. And our sense is that that big expansion raises the risks on bank balance sheets.